Okay, well, thank you very much for that kind introduction. I would also like to take a moment and just personally thank Erica Gorga for setting up a wonderful program, and to mention that Vanderbilt Law School and the FGV Law School here in Sao Paulo have an exchange program. We've had several of your students and faculty come and visit with us, and we look forward to continuing that relationship in the future. This particular paper is a co-authored paper with two colleagues from Wake Forest University, James Cotter, who is in the finance department there, and Alan Palmeter, who's in the law school. If you're interested, it's now available in the George Washington Law Review. There's an earlier paper, which is this talk is also partially based on, which is available in the Cornell Law Review. And I thought to motivate the paper a little bit, because I realize not everyone is terribly excited about American law, but I thought to motivate it a bit, I would try to maybe place it in a more broad context, and hopefully a context which is more relevant to the Brazilian audience. We have in the U.S. a dispersed ownership system, and by that I mean we don't generally have control shareholders at the companies in which our public companies are. And as a result, there isn't a tight monitoring of corporate management by a very self-interested, concentrated shareholder. And as a result of that, there is a concern that management compensation in the U.S. has gotten out of line with the levels that are in other parts of the world. And as a factual matter, that is true. American compensation is in a totally different category in terms of the dollars and cents from any other country in the world. So pay in the U.S. system can get very high, and our search in the U.S. system is to come up with an alternative monitor to your control shareholders. Now, by contrast, of course, here we just heard a lovely paper by Marcus Pinto, a former SEC commissioner, who was here, that's not SEC, CVM commissioner, who was talking about compensation in the Brazilian context and illustrating how their control shareholder dominated companies tend to pay more reasonable levels of compensation in Brazil than, for example, dispersed ownership companies do here. Now, the relevance of that fact is that the second fact that brings that really into focus is that there is an increasing trend toward dispersion of ownership in Brazil. And so the question, I think, eventually will be raised here, well, don't we need an alternative monitor to a control shareholder monitor in companies that are dispersed ownership, right? In other words, if we have dispersed ownership Brazilian companies, will we have the same type of pay gap that we're now seeing between the U.S. and Brazil? Will you see that developing in Brazil? So I offer the U.S. as a possible candidate. I give it a qualified endorsement. This is not a suggestion that this is the best system. This is our system, and this paper is really an attempt to evaluate how well it works. So a little background, a little international background. Say on Pay has become a really international phenomenon. There are now, by last count, about 9 countries that have adopted Say on Pay. And by Say on Pay, what I mean is either an advisory or binding, in some cases, shareholder vote, typically on the remuneration packages of the top executives. But it varies some from country to country. Some countries have votes on the pay policies of the company. Some vote on the entire executive compensation package as a whole. And there's been a lot of debate about whether or not this is a good development or a bad development. Pay critics tend to focus on the potential for Say on Pay to act as a meaningful check on the increase over time of executive compensation. Pay skeptics, including Brian Sheffens and myself, tend to believe this is not necessarily a solution to the problem of increasing levels of pay, but more perhaps a solution to the question of dispersion between companies, so that we expect, and what I think the results in this paper will show, is that Say on Pay has an effect of moving companies toward the middle. The companies that are on the very far outliers of the distribution are pushed toward the middle in terms of their compensation packages and compensation arrangements. So I won't spend a lot of time talking about all the arguments in favor and against. It's a wonderful literature, very colorful. People tend to take extreme positions one way or the other. But just to illustrate, again, in the context of our dispersed ownership system, some of the arguments that have been made, most prominently by Lucian Bebchuk and Jesse Fried in some of their work, that the concern with Say on Pay is really about accountability, that we want to increase the level of shareholder monitoring, hold corporate executives accountable to shareholders, and really shift the balance of pay in the American corporation away from the managerial power in the direction of more shareholder power. And along the way, there may be some other incidental effects, like, for example, we may reduce the rate of increase of pay over time. On the other side, you have equally strong opponents of Say on Pay who are concerned that within our management-centric system, that introducing the advisory vote or a binding vote will shift power away from managers towards shareholders. And they view that as a bad trade-off, because they think that centralized management and strong management is an important component of good economic performance. They also have a lot of reservations about shareholders' ability to effectively exercise the advisory vote. Now, I want to introduce, and I don't know if this is an organization which is prominent here in Brazil, but we have a series of what are called third-party voting advisors. And these are for-hire advisors who provide typically both information and voting recommendations to their client base, which in the U.S. system constitutes most of the institutional investors in our economy. And to the extent that ownership is concentrated in the U.S., it's concentrated in the hands of the institutional investors. So the most prominent of these third-party voting advisors is a company by the name of ISS. They have sometimes been called Riskmetrics. They're now called ISS again. They will figure very prominently in my discussion of the results of the paper. So just be aware that this is an important agent that acts to provide collective information and really helps to bring about collective action by the shareholders. Okay, so what is the Dodd-Frank Say on Pay mandate? Well, we've been talking a lot about Dodd-Frank today, indirectly or directly, where we've been talking about financial regulation. And my colleagues laugh at me because they say the only provision of Dodd-Frank that you care about is the only one that has nothing to do with what the statute was all about. Say on Pay really has nothing to do with financial regulation, but it was implemented as part of the Dodd-Frank Reform Bill. And what it provides is that companies have to give their shareholders an advisory vote on the compensation packages of their top 5 executives. It was implemented very rapidly by SEC standards, at least, so that we now have been up and running for a couple of years, and we're starting to get a sense of what Say on Pay really does. So I will not digress too long on the history, but I should just say that there is a history to Say on Pay. Not binding advisory votes, not mandatory, I should say, advisory votes, but voluntary votes, because we have a mechanism for getting shareholder proposals onto the corporate ballot using one of the rules of the 1934 Exchange Act. So in the interests of time, I'm going to skip over most of this, but the bottom line is just that there is this long history of having these votes take place. The votes have, by and large, not attracted majority support. And let me just illustrate that. Here's a time series of data on these different types of shareholder proposals running from 2003 to 2010. And you can see if you look, I notice the print is kind of small, so try to use the pointer. You can see if you look across the columns, here are the percentage votes in favor of this particular proposal, which is to issue an additional report. So by and large, these were not terribly popular voluntary proposals, with the exception of this category, which is labeled approved. And you can see there are quite a few proposals there, including 43 proposals that received a majority of the shareholders voting in their favor. And if you look down this column, you'll see almost none of the other proposals received majority support. But what this indicates is that there is a strong interest, even before Dodd-Frank was put into place, in having some sort of shareholder referendum on executive compensation. Okay, and that just summarizes the results from the previous table. By the way, this is all in the Cornell Law Review paper if you're interested. Now, later in the time frame, then, now we're up to about 2006, seeing actual proposals introduced to require a vote on the entire pay package, first by shareholders, but then, interestingly, by managers. So you started to see voluntarily placed on the proposal voluntary proposals by management asking for a shareholder advisory vote. Now, some of those were not voluntary, I should mention. Some of them were mandated by the TARP funding legislation. But even those, if you look down here, and you see this column here, this is for the percentage of shareholders voting in favor of management's pay. So this is an affirmative vote that we're voting on management's pay, and we agree that management's pay is appropriate. And you can see the numbers here are very high, all in the above, well, in the around the 90 to 95% range, and almost all of the proposals received majority shareholder support. There are only a couple of proposals that did not. So whilst we see shareholders wanting a vote, what this early data shows is that when shareholders are actually given a vote, they vote in favor of the management compensation package. And there's, again, a summary of the results from that table. So we roll now all the way up to 2011, and we have our first advisory votes on say on pay. And we could talk about why in the Q&A if you're interested. But there is a small subset of companies that did not succeed in convincing their shareholders to vote in favor of their pay packages. So the next, I think, interesting question is, we'll skip over that, why? Why did those companies fail? And the answer is a combination of two things. One is a perception by shareholders that the corporate performance was weak. In other words, that the total shareholder return, which is a measure of not only the capital gain the shareholders received in their stock, but also the dividends that they were paid over, typically measured over a 2 to 3 year time period, that return was low. And so shareholders are sending in part a message, when you perform poorly for us, we're not going to be so inclined to vote in favor of your compensation. And then the other issue was high pay. So, so if you have an excessively high level of pay beyond the norm, you're in some sense one of the high variation companies that's well away from the middle of the compensation package, then again, we're going to vote against your compensation package. Now, how does that show up? Well, principally, the way it shows up is through the ISS recommendation. Remember I mentioned earlier we have this third-party voting advisor, Institutional Shareholder Services, and they act to provide information and recommendations to institutional investors. So what this table shows is when you receive a positive ISS recommendation, then on average the voting support in favor of your say-on-pay proposal is in the high 90s, or low 90s, excuse me. On the other hand, if ISS decides that they don't like your pay package, perhaps you're not following their recommendations in some material way, and they recommend against it, then you see about a 30% drop in the level of voting support. So that's a very, very significant factor. Now, ISS doesn't randomly issue negative say-on-pay recommendations. They're out of the universe of several thousand American companies that held advisory votes in 2011. They only issued 285 negative recommendations. And even companies that received negative recommendations, by and large, still got more than 50% of their shareholders to approve their advisory say-on-pay vote. But nevertheless, the negative recommendations were a very big factor, and they did focus attention on these pay-for-performance issues, the high pay, low returns issue. So one of the things we do in the paper is we run a very simple model. What we're trying to explain here is the variation in the level of voting in favor of the proposal, and what you see is the big elephant in the tent is the ISS recommendation. An against recommendation leads to a very significant and large decrease in the voting support in favor of your advisory say-on-pay vote. Excess pay, and by that we use a measure that's taken from some work by John Corr and Wayne Gay. You do a predicted measure of compensation, and then you compare that to actual level of compensation. The difference is what they call excess compensation. So you can think of this as sort of a measure of the deviation from the norm. And when you deviate quite a bit from the norm, that also leads to a significant negative impact on your voting support. And then finally, if you both deviate, have high excess pay and low levels of returns for shareholders, there's a third independent negative effect on your levels of voting support. So again, very simple model.